Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial mysteries that shape our world. Some companies are really good at hiding their intentions, but today we have a report that will shed some light on some very interesting dealings. Today we're diving into Lument Finance Trust's latest filing, and believe me, it is not your average corporate announcement. We're talking about a major financial maneuver that could have significant ripple effects. Before we jump in, if you are someone who likes to get straight to the juicy details of corporate filings without all the extra fluff, make sure you are subscribed. And hey, if you want to chat more about these findings and connect with other finance enthusiasts, join our Discord community. The link is in the description below. Alright, let's get straight into it. Lument Finance Trust, or LFT as they're also known, has just dropped a report detailing some serious financial activity. It all centers around something called a commercial real estate collateralized loan obligation, or CLO for short. Now, that might sound like corporate jargon, but it is essentially a way for companies to bundle up loans and sell them off to investors. Think of it like packaging a bunch of mortgages into a new financial product. In plain English, LFT, through a subsidiary, has put together a package of loans, mostly related to commercial real estate, and they've sold off pieces of it, called notes, to raise a significant amount of money. They've raised about $585 million from what they call investment grade-rated notes. That means these are considered safer investments. Then, there is another chunk of about $78.8 million in what they call below investment, grade-rated notes which are a bit riskier but can offer higher returns. So, who are they selling these notes to? The safer ones went to institutional investors, the big money players like pension funds and hedge funds. The riskier ones went to an entity called LMNT Holder, LLC, which is actually a subsidiary of LFT itself. This is an interesting move, sort of like the company keeping some of the riskier bits for itself. Now, what are they doing with all this cash they've raised? The report says the money will be used to buy more loans, pay off existing debts, and cover the costs of this whole operation. This CLO deal is structured with a reinvestment period, meaning they can use the money from these loans to buy new ones for about 2.5 years. This shows they are actively managing and looking to grow their loan portfolio, but that is not all. LFT is also shoring up its lending capacity in another way. An indirect subsidiary of the company has entered into a loan agreement for up to $50 million. This credit facility is designed to finance first mortgage loans and loan participations secured by commercial real estate. They'll be using this to finance both performing and non-performing loans, as well as properties they've taken back, known as REO properties. This new credit line comes with some specific terms. The amount they can borrow against the loan or property is tied to its value, with a limit usually around 60 to 70%. Interest rates are based on a benchmark called SOFR plus a margin. What is interesting is that if they prepay a loan, the bank providing the credit facility, Northeast Bank, will still earn at least 6 months of interest. This protects the lender's income. On top of this loan agreement, Lument Finance Trust itself has provided a guarantee. This means if their subsidiary runs into trouble and can't meet its obligations, LFT, the parent company, steps in, but only for specific bad acts mentioned in the agreement. It is a way to provide some extra comfort to the lender without the parent company taking on all the risk directly. Let's dive a bit deeper into the structure of those notes from the CLO deal. They're not all the same. They're broken down into different classes, each with its own level of priority for getting paid back. We have class of notes which are the senior most, meaning they get paid back first. There are about $378.4 million of these. Then there are subordinate classes like the Class A's Class B, C, D, E, F, and G notes, each with a lower priority. Finally, there are the Class H income notes, totaling about $43.1 million. These are the riskiest because they get paid last. Remember, the safer notes held by institutional investors are the Class A through E, while the riskier ones, F, G, and H, went to their own subsidiary. The entire package of these notes is backed by a portfolio of loans and cash worth about $663.8 million. These are mostly commercial mortgage bridge loans, which are short-term loans used to finance the purchase or renovation of commercial properties. LFT intends to own this portfolio of loans through its subsidiary and will account for the money raised from the notes as a financing activity on its balance sheet. Interestingly, many of the loans included in this package were originally held by other LFT affiliates, like Lument Commercial Mortgage Trust and Lument Structured Finance. Some were even being financed through repurchase agreements, which are short-term borrowing arrangements. This shows a complex internal movement of assets before they were packaged into the CLO. To manage these loans within the CLO, Lument Finance Trust has hired its own external manager, Lument Investment Management, to act as the collateral manager. This manager will advise on which loans are good investments for the CLO. A key point here is that the collateral manager has waived its management fee for now, as long as it or an affiliate remains the collateral manager and LFT's external manager. This is a cost-saving measure for LFT. It is important to understand that these notes are what is called limited recourse obligations. This means that if the loans backing the CLO perform poorly and aren't enough to pay back the note holders, neither the issuer nor any of LFT's affiliates will be obligated to pay the difference. The note holders can only go after the collateral itself. Now, let's talk about the interest rates on these notes. The notes sold to institutional investors, the ones considered investment grade, have an initial weighted average interest rate of about 1.91% plus a benchmark rate called Term SOFR. Payments are made monthly, with the final maturity date set for July of 2043. The report also mentions that these notes might be paid back earlier than their stated maturity, which is typical in CLO structures as the underlying loans are paid off. There are also provisions for redeeming these notes early. The company can choose to redeem them if the outstanding loan balance drops to 10% or less of the original amount. Additionally, starting in May of 2028, the holders of the riskiest notes, the Class H notes, can push for a redemption of all the notes. There is also a mandatory redemption if certain note protection tests aren't met, which could happen if the underlying loans start performing poorly. A really important detail here is the skin in the game requirement. To comply with regulations like Regulation RR, Lument Commercial Mortgage Trust, an affiliate of LFT has to hold onto a portion of the riskiest notes, the Class H notes. They need to keep at least 5% of the total value of all the notes. This is to ensure that the originators of these loan packages have a vested interest in their performance. They're also committed to maintaining a significant economic interest in the securitization through various regulations. And to top it all off, Lument Finance Trust also announced they declared a cash dividend. For common stockholders, it is $0.04 per S-share, and for the preferred stock, it is a much larger $0.4921875 per S-share. This shows they are returning some capital to their shareholders. Now, let's zoom out and look at what this all means. Lument Finance Trust is actively engaging in complex financial engineering through these CLO deals. This is a standard practice for companies in their sector. It allows them to originate more loans, manage their capital more efficiently, and generate fee income. The partnership with Northeast Bank on the credit facility also expands their lending capacity. The structure of the CLO with different tranches of notes means that risk and reward are distributed. The senior notes are safer but offer lower yields, while the junior notes are riskier but offer the potential for higher returns. The fact that LFT is keeping some of the riskier notes shows confidence in the underlying loan portfolio, but it is also a point to watch. Given the sheer size of the CLO, nearly $600 million in notes, it signifies a significant operation for LFT. The terms of the loan agreement, particularly the minimum interest provision, suggest a focus on predictable income for the lender. The retention requirements for the Class H notes are crucial for regulatory compliance and investor confidence. Overall, Lument Finance Trust appears to be executing a well-defined strategy of expanding its lending activities through securitization and leveraging credit facilities. The company is demonstrating its ability to access capital markets effectively. The risks are inherent in the commercial real estate sector and the complexity of structured finance, but the company is taking steps to mitigate some of these through diversification and regulatory compliance. Alright, that is our breakdown of Lument Finance Trust's latest filing. What is your take on these financial maneuvers and what they signal for the company's future? Do you think these CLO deals represent a smart growth strategy or a potential risk? Drop your thoughts in the comments below. If this deep dive was valuable, hitting that like button really helps us out, and subscribe for more of these corporate dissections. Don't forget to check out the Discord community in the description to continue the conversation. Thanks for watching, and we'll see you next time.